Welcome to the daily update. This is being prepared Friday, September 16th, where we'll look at the action in the market today and then see how things look for Monday, September 19th. And it's turning more negative here, folks. We ended up losing the support that we were kind of hanging on to right at the 3,900 level. So that's kind of a big deal. And our charts are looking pretty negative right now. We might be getting some short-term oversold conditions that are starting to build here. But the way things look right now, I mean, anything can happen. And a lot of times the Monday after options expiration can be a negative day. So doesn't mean that it always is, but it can be negative a lot of the time. So right now, we're just not looking at a market that really wants to go up, which is really strange because exactly a week ago, the market was starting to look pretty good. All right, let's go back and talk about what happened. At the open, we had a gap lower open, and we actually went below S1 at 38.73. We dropped below S2 at 38.45. As the day went on, we spent kind of a ping pong match going up and down. They bounced between S2 and S1, and we never did really see any kind of an attempt to take things positive. We closed at about S1 for the day. We ended up being down 0.72%. Volume was way, way above average. Now, this is because it was options expiration Friday for the monthly options. And you see a lot of position adjusting happening. And so we see a real spike in volume on those days. The technicals continue to be negative. I'll go through the charts and just kind of discuss some different things because inflation and interest rates continue to be the real focus of the market. Sorry. And I just don't want to get started on this again. All right, what are some comments that we can make? It was options expiration. That explains the big volume. The S&P broke below 3,900. We do have three of our yield curves that we follow remain inverted. The 30-year to the 5-year, and I actually have a chart of that this time, the 10 to the 2 and the 10 to the 5. Sentiment is, with the down day, still slipping a little bit more fearful, but not giving us an extreme reading. We had really the only economic report was the preliminary consumer sentiment reading came out. They expected it to climb back to 60. It came in at 59.5, so that was a little less than expected. And I have a chart to show you for that. Our trend is negative, and we're still below 20, even with the 0.75% drop. We haven't turned up with the ADX yet. Our bias is negative with the down day, and in the last number of days, the momentum has clearly switched over to negative. Let's go back and talk about this. This is what we're kind of dealing with right now as far as interest rates. A week ago, it was over 90% certainty that the Fed was going to raise interest rates 0.75% at their meeting coming up this week. Well, then we had that big CPI report come out. And all of a sudden, now we're starting to hear talk of possibly a 1% increase at this week's meeting. This is falling down a little bit. The percentage is dropping. So as of right now, it still looks like we'll be getting a 0.75% increase on the 21st. Sentiment is still tipping a little bit more into the middle of the fear category right now. And then here's the sentiment reading. This is the blue line here where we had went all the way down to 50, which was like the lowest reading they ever had in this survey. We've been bouncing back up. We are showing some improvement, and that's probably due to gas prices going down. They thought it was going to get back up to 60. It only got to 59.5. We're still seeing a really large gap between the 2-year Treasury yield and current sentiment. Even though it's declining slightly, they're still very, very far apart from each other. And one of these is probably going to have to give at some point. And already it's taken some time to work its way out. But we generally don't see them this far apart for this extended period of time. So this just is showing the different ways that the economy is shifting and changing right now. Here's the latest reading, which is a couple days old, with the Ridex Bear Bull ratio. And we're still just in about the middle. We saw a bit of a spike up after the big down day when the CPI came out, but then we're seeing it kind of evening out. So we're not getting a real excessive reading, either positive or negative right now. Here are some Isabel net charts. This shows the S&P 500. That's the dark blue line here. You could even say black. Then you have the stocks 600. That's more European right here. And that's the lighter blue line. And they're starting to run into some trouble too. Topics, that's Japan. That's the gray line. And then you have the emerging markets, which is the dark blue line. And a lot of folks get into emerging markets investments to get some diversification, but they've really been underperforming. And if you convert all of these currencies into the local area that they're in, it just shows that even with the strength in the dollar, it's still underperforming on a relative basis when you compare it to indexes. Here's another chart showing the Fed funds rate compared to the S&P earnings per share. And this is the annual change, where we're still going through the process of the Fed funds rates being raised down here on the bottom. And as that is happening, we're seeing an overall downward movement of the earnings per share, because as interest rates go up, as the economy starts to slow down, companies don't earn as much money. This next chart is just showing the unemployment rate. This is what Goldman Sachs is predicting. We're right now at about this level at 3.7. I thought we actually dropped below. Oh, we did tick up a little bit. They think it's going to top out at 3.8 in 2023. Next one. This is showing inflation, and this is Deutsche Bank. That's what the DB stands for. That's a German bank, very influential in the European Union. And this line right here, this is where we're at. And they're expecting inflation to start rolling over. That's these scenarios that have been developing, only to have the Fed come out and say, no, 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 we're going to keep raising interest rates. Or they start to develop this scenario just a week ago, and the CPI comes out and it doesn't decline as much as they were hoping. And that freaks the market out right there. But they're still going with this idea that at some point inflation is going to roll over and start to head lower. But we don't really know that for sure. There's some people that think we're just getting started. Inflation is just going to go much higher from here. But that's not what they're suggesting in this chart. Then just to kind of show you the right now anyway, Bitcoin in particular and cryptocurrencies, they've been getting hit really hard. They're pretty much following the tech sector right now. So if you do trade any of those instruments, I just look at them, but I'm not actively participating in those markets. Well, it's great as everything was going up and people were treating it like a cash machine. Well, it's really been coming down as stocks have been coming down, specifically the tech sector. And so we're seeing a lot of money coming out of Bitcoin in particular. And then here's a chart, and this is the NYSE index. So it doesn't take into account the weekend session and the overnight sessions, but we're hanging out around anywhere from under 20 to a little bit over 20. And we've been chopping sideways now for quite a while. The GDP now was revised again. This was actually a little bit higher, but with some more economic reports coming out, this forecast is suggesting that for the third quarter, we will have positive GDP, but it's been lowered from what it was before, almost by a full percentage point. This is just showing I'm sorry that these charts are kind of fuzzy. When I do a screenshot, I don't really have a lot of control over that. But this is retail sales, real retail sales. This just, when it says real, that just means they take into account inflation. And this shows that it was really, if you remember, my God, 20 years ago, how we got out of that recession after 9/11. A lot of people had equity in their homes. Interest rates were pretty low and people were refinancing. And they kept saying, go out and buy. And it was really the retail folks that helped the economy come back. Well, everything went down the tubes during the great financial crisis. And we're seeing still an increase in retail sales overall, even though it's flattening out right now. This is not necessarily what you see. Well, you do see a flattening out right now. This sometimes can happen before a recession hits. All right, then we had the latest reading of the active asset managers, where they'd really fallen down after we were going down. Now, remember, this is a week old, and so they're bouncing back up slightly when things were starting to look better. With this past week, it's probably going to go down even more. Looking at the session on Friday, we saw growth down, but not quite as much as value, but all the different areas were negative in Friday's session. But this is another interesting thing. We're not seeing the VIX really spiking up. And usually when the markets go down, that means people are doing a lot more hedging. And we see the values both on the line chart and the bar chart really start to spike up. We're not seeing that at this point. So the VIX isn't really giving us a lot of high readings to suggest that we might be getting near the end. Because when this really spikes up, that quite often signals a bottom. So this might suggest that there could be some more pain to the downside. Here's the VIX of the VIX, which has also pretty much been going sideways and actually declined a little bit in Friday's session. The Ulcer Index is back down to almost neutral. It turned up a little bit with the downward movement. If you look on this chart, this actually is kind of positive, where we gapped down. That's negative. There was a gap lower, and then we set a low, and then we came back and almost closed at the high for the session. This sometimes might suggest there could be a bounce after this, because that's seen as somewhat positive in the wake of real negative market action. But overall, we're still in a pretty solid downtrend. Then the mass index, I bring that up just because we're getting close to the point where we might cross above this blue line. That's signal number one. And then when we drop below that and hit this dashed line, that's when signal number two is generated. And then that's a full-blown signal. This doesn't tell us the direction. This just says that there's a chance that something is going to happen and it's going to be big. We want to keep an eye on this because in the near future, it might generate a signal, even though it's not giving us a signal right now. We're down 19.62%, getting really close to that bear market of 20%. If you go back to the all-time high, and we saw the equity put call ratio really advance, which should not be surprising. People are freaking out. The market's going down, so they're buying more more puts than calls. The average is starting to turn back up when we go back over the last 5 days. Here are the pivot levels for Monday's session, and they're not all that far apart because most of the move in Friday's session was the gap lower. We were down as much as 1% just in the overnight futures. The market opens up and then pretty much went sideways overall. Even though we were down, that was induced by this gap that's right here. Then we were kind of holding out hope that we had been able to stay at this trend line and possibly get a bounce. Well, that didn't happen. And we're falling even further. We do have a support level right below where we're at currently. And then you can also see the big spike up in volume with options expiration. Here's the updated chart for the daily pivot point levels. And then here's the Fibonacci where we're coming down. I drew this line to kind of extend it over, where we broke through this layer of support, which had been resistance, then it became support, then it looked like we were going back up. Now we've come back down and we're getting close to this other fib level. Now we're well off of that right now because we closed off of the low in Friday's session, but we want to keep an eye on this, which is right around 38.25 to 38.29 or so. Then this, I haven't shown this in quite a while. We're starting to come right back down to the midpoint of the channel. We're not there yet, so we want to keep an eye on this chart, but we're getting kind of close, and we might get down to this level if we see further weakness. Here's a weekly chart, which I haven't shown in a while. We're coming down to what had been support, and see how we bounced off of this 38.2% retracement. That could be somewhat positive. And this bar right here is for the entire week. So it shows that we did bounce up slightly from the low. Looking at the sectors, 9 out of the 11 were negative, with energy leading the way lower, followed by industrials and materials. The two sectors that were up were real estate and staples. All right. Looking at the technical analysis scores, we're still showing that energy and utilities have the best looking charts right now. They're into the mid to high 90s, with communications down at 6.7. So here are the sectors, still showing that energy is doing the best, followed by utilities, with the rest of the sectors being negative, going back to the all-time high in the S&P. This is how the different indexes have been performing since we set the all-time high in January, and everything is underwater. Currently, all the technical alerts were negative. Really, the only one for the S&P was that we dropped below 3,900, but the NASDAQ, 11.5, 11.4, not as big of a deal as it could have been. But we're seeing a lot of sectors really have negative signals that are being generated in technology, industrials, communication, materials, cyclicals. They're all, and their BPI charts are really showing some weakness. Gold, even though it's supposed to go to the moon, it's going in the opposite direction right now. And oil has been dropping. It's down below 85. Here's our scores. We still have mid caps, which this is nothing to brag about, 50.9, but it's still doing better than the other major indexes that we look at. The Dow is at 50.2. The S&P is in third place at 42.5. It actually bumped up a little bit. Some of our charts liked the fact that we closed near the high for the session. And then the small caps are at 32.5. And in last place, even though they improved slightly, we have the Qs, which is the NASDAQ 100 at 16.7. So just not a healthy looking environment. Here's the gap lower, and I kind of went through this already. We came down to S1. We bounced back up, down to S2. We went back up to S1, and then we kind of ping-ponged around and ended up closing right at about S1 for the session. Our trend, it's turning back up, but we're still slightly below 20. Now, we get another down day, this ADX could possibly go above 20. It's starting to cross above the moving average. The red line's on top, the green line's on bottom, so this is a negative trend if it develops. We finally saw some movement from the Arun. We got out of this whole mess that we've been in for a while and kind of broke below that. And it's showing that selling is really increasing as buying is decreasing. When you compare the two, our oscillator is going down. Looking at breadth, pretty negative day overall. We saw a decline based on price and volume. Our advanced decline ratio is also looking more negative. It's dropped below 0. The new highs, new lows, we saw a real expansion of new lows in Friday's session. So this is beginning to roll over with our 5 period. It was trying to show some improvement, but that didn't last very long. And then our 10 period is starting to roll over as well. Accumulation distribution. This is one thing that was a little bit positive. With this coming down to S1 almost and then bouncing back up, well, the accumulation distribution like that. So it actually advanced in Friday's session. Short term, we're still looking a little extreme negative if you go back over the last 5 periods. And then here's a chart I don't show all that often. This is a triple exponential moving average and a double exponential moving average. That's what these crazy moving averages are here. The reason I brought this up is I have a moving average that's anchored all the way back to the March 23rd, 2020 low. That was the COVID low. We were able to break back above that. Well, now we're starting to break down below that. Our Stochh RSI starting to get extreme negative. Williams percent R is already extreme negative. Force index also declining. Swinland trading oscillator declining and now falling below 0 based on price and volume. McClellan oscillator declining and below 0. Our 20 period starting to get extreme negative, still declining with the 50 and the 200. Stochastics trying to turn back up after being extreme negative, but not really getting a lot of help there. Still extreme negative intermediate term, and after showing some improvement in the longer term, we now see the stochastics rolling over. Looking at some intermediate term charts, we're also a little overextended to the downside if you go back 20 periods with the rate of change. Our Sean trend meter is still showing weakness. The PMO is negative across the board. The PMO studies, a little bit extreme with those PMOs that are rising. The buy signals are also getting extreme negative. This is part of the oversold condition that I'm talking about. We could still go lower from here, but we're developing what potentially could be an oversold condition. And then those PMOs that are above zero continues to decline. Chaikin oscillator. This is another one that actually turned up. It likes the fact that this bar closed near the high for the session, where the Chaikin money flow showing a little bit of improvement, but is still negative. We saw the big spike up in volume. The vortex, it's showing that the red line is going up as the green line is kind of a little bit up to mostly sideways. So this is negative. The summation index based on price and volume continue to turn down. The slope, it's still trying to go higher. I'm not sure what it's looking at, but it's positive right now, but all of our other oscillators continue to be negative. The BPI dropped below 50 and is showing continued downside movement. Ease of movement actually came back up when you go back 14 periods, so showing a bit of an improvement there. So it's picking this up that we closed near the high. Ultimate oscillator, it is still negative and declining. Money flow index also declining. Haven't shown these in a while. The CCI 14 starting to get extreme negative, and the CCI 20 is starting to get extreme negative. Here's the TTM squeeze. It's continuing to go higher. It's like, what downtrend? Nothing's happening here. It's still going up. So that just doesn't seem to be a really valid signal right now. The balance of power, it's another thing that turned up slightly in Friday's session. So we want to keep this in the back of our mind, that maybe the markets will see this low bar right here kind of off all by itself, and that it closed near the high, and then maybe get some kind of support off of that. That's what some of these indicators are possibly suggesting. We're now having close to a confirmation of a downtrend with the composite index, where the signal was generated when we drop below the green line, and it's coming right down to the red line currently. Our different charts, the Heiken Ashi, solid black candles, that's negative. The Kegi has switched to red. Took a little while, but it finally switched. That's negative. The Renko chart still has two red boxes. That's negative. Three-line break, also negative. We have a new, and I tried to make this a little bigger. We have a new zero that was drawn in on the point and figure chart, and it's actually generated a signal. This is a double bottom breakdown, which could be happening because we're coming right to the underside of this. If we go any lower, it will break this trend that I'm trying to outline with my cursor. We are negative with the S&P 500, with the Elder Impulse system, as well as the SPY. The SAR, and I said it right that time, is negative with the dots on top. Our go, no go is in a deep purple mode, so that's negative. Long-term charts, we're showing a real decline in the 50, 150, and 200 moving average studies. Special K continues to go lower. This is a chart, this is a screenshot from a podcast that I was watching. And I'm going to do some research myself and try to match this chart. I just didn't have time to do it before I recorded. But this red line, this is showing the price action in 2008 going into 2009. And look at how things went in the toilet after that. And the blue line, this is how we've been doing since then. And there's a lot of parallels between the two. So does that mean we're really going to fall from here? Does that mean we really are going to go a lot lower? Now, I want to reproduce this chart myself. This is just something that I found that somebody else produced. I didn't even know the source. Somebody just said, I want to show you a chart. And it was enough to freak everybody out. So I'm going to try to work on this and see. All right. Broad market. We are negative with the diamonds. And it's going to be a little hard to see some of these bars because of the volume spike. But really, the Dow held up better. It was down 0.45%. The Qs were down 0.61%, but they continue to be negative. Here are the Qs, and they're kind of lost in these volume bars right now. The Vixen, it's not really going up the way we would think. So this has more room to go up if we continue to fall lower. The NASDAQ came down to S1, went a little bit below that and bounced a little bit up off of that, but was still down 0.9%. The mid caps, yeah, they were down 1.35% and are starting to show some weakness. We still have S1 down below current prices. The Wilshire also starting to come down potentially to this S1. It closed in about the middle of its bar. So the positive things that I'm seeing are more in the NASDAQ and in the S&P 500. The dollar, it was up slightly, virtually unchanged, but still up 0.02%, still in an overall uptrend. The relationship or correlation between the dollar and the S&P continues to be pretty strongly inverse. So if the dollar is going up, the S&P is going down and vice versa. Gold, after really coming down, had a nice little bounce. It was up 0.55%. And silver also had a pretty good bounce, up over 2% in Friday's session. But both of these, both gold and silver, continue to be in overall downtrends. Oil dropped a bit down to 84.76. And the correlation between the S&P and oil is in neutral land right now. So it's not really telling us anything. Bonds continue to have some problems. In our other chart, we're also dealing with prices going below the COVID low as interest rates continue to go up. The stock to bond correlation, they're having a slight tendency to go in the same direction, which means they've been going down. Because bonds have been going down as interest rates are going up and stocks have been going down. Our yield curves, here's the 10 to the 5, which remains negative, and the 10 to the 2, which is still negative. And here's the chart of the 30 to the 5, where it's dropped negative again. We're still keeping an eye on the 10 to the 3 month, but it has yet to go inverted. The tech sector to the 10-year yield, pretty much neutral, but having a slight tendency to go in opposite directions. And here we saw long-term rates actually come down as well as the 10-year, but some of the shorter-term maturities are going up and down. It's like bumper cars as we're going all over here. I'll just go through this really quick. Here's the Copic curve. This is another one of these signals that doesn't tell us the direction, but it may suggest that something is getting ready to happen. Right here, we're starting to see a cross above this moving average. This is starting to show weakness, those stocks above their 200-day simple moving average, and the same thing with the 50. When we look at the mid caps and the small caps, they may end up going down and generating new signals. And here's the 10-day average of the highs and the lows. It really hasn't changed all that much. And then the broad market look still shows that we're negative overall, with the 5-period moving average of the highs minus the lows. The equity put call ratio longer term chart, it's starting to spike up slightly, but we're seeing not a lot of follow through action in the VIX, but we are seeing some follow through action with the put call ratio, and it may end up going back and generating a new signal. Small caps were down less than the S&P, so they actually outperformed. They still have S1 down below current prices. Here's the ratio. It ticked up slightly because it did better than the S&P 500. We're really not getting anything from this chart, at least yet. And the correlation between the S&P and the 10-year yield is still in neutral territory. The only part of our rotation that is still holding up is discretionary, and it was a bit flat, but it's looking more positive, where the rest of these rotation ratios are actually declining. And we're seeing declining specifically in the large caps, where they're a little flatter with the mid and the small caps. And the correlation between the S&P and the 2-year yield tends to be more neutral, with a slight advantage of going in the opposite direction. And we're seeing a new spike. As the 2-year yield goes up, it takes out the spike that we've been looking at. So now we're waiting until another spike happens, and we don't know when that will be. The utilities continue to outperform the S&P, or said another way, the S&P is underperforming utilities, so this tends to go down. So this chart tends to follow the price chart of the S&P. So as long as this continues to go down, we're not really getting any support that could help prices go higher when you look at this ratio. Staple sector was actually up 0.25%, and we're still not back to this spike right here, but we did see an advance in the staples to S&P 500 ratio. So what's our outlook for Monday? The technicals, yeah, they're negative, folks. Economic reports, we have the NAHB Housing Market Index coming out. all the geopolitical events. But the thing, at least as the time I record this, it's inflation and interest rates. And then we've got the Fed coming up this week. They'll be meeting on Tuesday and Wednesday. They'll make their announcement on Wednesday. So our scenarios, we could go with the down scenario if we see follow through downward action because of all of these different reasons here. And our technicals are decidedly negative. It's really hard to be positive because the technicals are so negative. The one positive thing that we could hold on to is the formation on the daily chart of closing near the high. We'll see if the market's able to build off of that. But our scenarios, our rotation, and our setups, those are all on hold and maybe getting ready to generate some new signals. Our technicals are negative. We've lost all the moving averages. We're going through pivot points. We're falling through support. That's negative. And if you try to get in long positions or up positions at that time, it's like getting in front of a freight train or trying to catch a falling knife. We could go sideways with our scenarios because the ADX is still below 20. It does have a negative slant to it. If we see follow through downside, it'll probably go back above 20. So our conclusion, not hard to make. Everything is pretty much negative across the board. So thank you. Have a wonderful weekend. I will be posting the weekly video and the intermarket analysis video over the course of the rest of the weekend.